Office collections have held reasonably strong and resilient throughout. And this is not just true for us. You have seen the numbers reported by the listed REITs and by other players. And the office collections have consistently been in the 95% plus mark. Yes, there have been marginal slowness, and I'm sure there have been incidents across the geographies where individual tenants may have come in for rent renegotiations marginally or for deferring the escalations that were contractually due. And those obviously we are also handling on a case-by-case basis. Our new building, the Cyberpark, which was due to actually go live during the April-May period, got deferred by 3 or 4 months. But most of the tenants have commenced the interiors, and from 1st October, we expect that we should be in the rental mode. The retail mall segment is the one that has been most visibly hit. I mean, 3 months, obviously, they were completely locked down. Then, even though the lockdown was listed, the restrictions continue. I mean, 3 sort of restrictions. One is clearly restrictions on entertainment zones and bars. B is restrictions on operating times. And C is restrictions of social density. And D, obviously, which is the unwritten restriction of people still, feeling fearful of going into public social places. And I think that is we were amongst the first ones to offer rental rebates and all. But I think that is the sector which may take longer to sort of begin to show signs of normalcy, maybe 1 or 2 quarters delayed as compared to the other sectors. That's the broad piece. Things looking up, clearly nowhere near what they were in the pre-COVID levels. But hopefully the extreme abyss of darkness in the April-May timeframe, that should be behind us.
Okay, let's now talk about the rental income, Mr. Tyagi. You've been, the company has taken a very judicious and a very empathic call and perhaps have looked at addressing the concerns for your tenants. You've taken an option of giving one-time rental and reducing rents down. But ultimately, shareholders would say that, look, this is a cash flow which was a strong proposition for DLF. So what will happen to rental income in next 2 quarters, and the cash flows which have dipped largely because of the waivers you've done, when will they recover?
So the offices rentals have sustained, they have been extremely resilient, and our office rentals continue to be in the 95% plus collection range, 95-96% collection range. So actually, contrary to what one reads in the pink newspapers, the office rentals haven't so far dipped. Yes, there have been isolated discussions, which are understandable given the way the times are. We ourselves sort of debated internally for about 3 or 4 months, and then decided to continue with our 2 existing new capital assets creation, one in Gurgaon and one in Chennai, with both of whom should be on stream maybe in about 24 months from now. So the office collections is good. The retail collections is where the pain has been and where we have given all these waivers that you mentioned about. I mean, retail collections for us is about 1/6 of our total collections. And we do believe that this particular year, we should clearly have we would have a net deficit on the retail piece. But again, if what early trends, what one is looking at, what one is looking at in terms of retail bounce backs in other geographies of the world where COVID which were at an early cycle of COVID, including China, maybe even for retail, it's a question of 2 or 3 quarters, where when things are uncertain. And eventually it should begin bouncing back. Obviously, the retailers will have to, I guess, to some degree, weave in the online experience into their, into their sales strategy. And that's something that obviously the retailers, the mall operators, and everybody will have to sort of, work on with the technology backbone. So every time you want a new bag or a new dress, you don't necessarily need to go physically to that shop. You could maybe order online from that shop. And those sort of, I think, I'm sure innovations will happen. So retail is the one which would have a slightly longer interim pause period. But again, fundamentally, from a shorter standpoint, as you mentioned, that, what they should look at is hopefully a 2 or max 3 quarters interim, a pause on the growth trajectory of the rent. But we believe that the rental trajectory that we had earlier guided the market to, that by March 22, we should be on an exit run rate in excess of 4,500 crores per year. We still believe that that could get delayed by, say, 3 quarters, but the basic trajectory should not really get fundamentally compromised. That is the set of assumptions and the sort of the house view as of today. Obviously, the only big unknown in this is how does the COVID play out 6-9 months from today, and that's something that obviously, we have to just wait and watch. But given where we are today, I think we do expect that the trajectory has been sort of slowed down by 2 or 3 quarters, but fundamentally the trajectory isn't going anywhere.